Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 21. A Limited has an expected return of 22% and standard deviation of 40%. B Limited has an expected return of 24% and standard deviation of 38%. A Limited beta is 0.86 and B Limited beta is 1.24. The correlation coefficient between the return of A and B is 0.72. The standard deviation of the market return is 20%. Now suggest, is investing in B Limited better than investing in A Limited? By overall seeing, we can see that the standard deviation is more in case of A, and then in case of B it is less. And comparatively, return also is more in case of B than A. In perspective of return, B is more, and in perspective of risk also, B is more compared to A. So with less risk, more returns are achieved in case of B Limited. Same thing ICAI also given, and they've added one more point. If we invest in both shares, then we'll get the advantage of diversification, as the risk also will reduce for the same level of return or the expected more return in some circumstances. Now the second requirement is, if you invest 30% in B and 70% in A, what is your expected rate of return and portfolio standard deviation? Expected rate of return we can directly found out by, we have the expected returns of A and B multiplying with the weights given 30% and 70% will give us the expected return, which is nothing but 22.86. Portfolio standard deviation we have to find out separately. It will not be a direct weighted average, as we have discussed in our previous problems and discussions. We know that in a portfolio, if we are investing in more than one security, two or more, the risk of individual returns will be more, and compared to portfolio return, the risk will be less. Why? Because there is a advantage of diversification, because the unsystematic risk portion will get reduced when we diversify our portfolio. That is the ideology. So it will not be a weighted average always. For calculating the uh, standard deviation, which is nothing but the risk of portfolio, we have to use as usual the A plus B the whole square approach. A square plus B square plus 2AB multiplied by the correlation coefficient of A and B. Now we need, they have already given correlation coefficient of A and B, nothing but 0.72, and we have the risk also and we have the beta also. Now here A square signifies nothing but weight of A multiplied by standard deviation of A the whole square, and then B is nothing but weight of B multiplied by standard deviation of B the whole square, then 2AB, same thing, 2 into weight of A standard deviation of A, weight of B standard deviation of B multiplied by RAB. Same thing we can notice here. This is nothing but weight of A multiplied by weight multiplied by standard deviation, which is 40%, the whole squared separately. Since it is in multiplication, anyway it's same. This is A square and this portion is B square, and 2 into weight of A multiplied by standard deviation of A, nothing but 0.4, weight of B multiplied by standard deviation of B 0.38 multiplied by the correlation coefficient of 0.72. So this is same as that formula, but please don't write this A plus B the whole square there, it's just for the remembrance. We are getting a value of 0.1374. We can write this one, weight of A multiplied by standard deviation of A the whole square. That formula you can write, but don't write A plus B the whole square. So we are getting a value of 13.74%. which is nothing but the variance of portfolio. Now routing that will give us the standard deviation of the portfolio. Now the third requirement is, what is the market portfolio expected rate of return and how much is the risk free rate. So market portfolio expected return is nothing but RM and risk free return is nothing but RF. So we have to apply CAPM approach to find out this. Since we have two companies written, we can follow CAPM method. Substituting that, we will be creating two equations. So in our case, this will be the first equation and this will be the second equation. Then simultaneous equation method, by just doing all the negative signs and then eliminating RF, we will get RM minus RF, risk premium value. Then we'll be deriving this 17.48 as the risk free return and RM will be 22.74. The fourth requirement is, what is the beta of portfolio if A's weight is 70% and B's weight is 30%. As we have previously discussed, beta is the sensitivity of the returns towards the market return. So beta will be a fixed variable for all the returns with this, which is nothing but the sensitivity. So we can directly find it out by weighted average in case of portfolio beta. So since we know the weights are 70% and 30%, we can directly multiply with the betas already given and then we can arrive at the portfolio beta, nothing but 0.974. Thank you.